Hello, this is Charlie Jewett with the Renovating Retirement Podcast, and I've been studying markets and the alternative strategies to just putting money in the stock market now for almost 20 years because of something that happened to a family member. And I wanted to show you a new spreadsheet that I made and just explain a few things that hopefully will be clear to understand. Most people are familiar with the red line, which is S&P 500 or just markets in general, buying the market or investing with a broker with mutual funds and things like that. Market goes up, market goes down. If we track most brokers' history, they basically go up and down exactly the same as the stock market does, as the S&P 500. Warren Buffett teaches not to use a broker. Just tells his wife if he dies, just put your money in the index directly, buy the S&P 500 directly, don't use a broker. So the red line kind of goes up and goes down. You get 100% of the ups. If it goes up 20%, you get 20%. If it goes down, you get 100% of the downs. Your money loses. And you can see over here in the early 2000s, the market goes down, it tends to fall quickly. And then there's a rebound. It falls for 2 years and goes 1, 2, 3, 4, 5 years up. So it takes 2, 3, 4, 5, 6.5 years to get back to where you were and have the same money that you'd already saved. So two problems here. One is you can lose money and have less money there when you get the big returns. Maybe from here to here is a 20% year or a 30% year, but you're earning that big percentage on a small account. And secondly, you can never make more than 100%. You can't beat the market. If you're in the market, you can't beat the market. So if it goes up 35, you get 35. If it goes up 10, you get 10. So there's a way to protect your assets from losses and also to beat the market and make more than it makes today. Hasn't always been true. You can even see on this chart in the early years here, market goes up, we didn't make as much. Market goes up, we didn't make as much. And I'm going to talk about that today. You do not need to beat the market to beat the market, as long as you don't have the losses. And I'll show you the spreadsheet. But this green line called indexed, usually indexed annuities with insurance companies, or indexed universal life insurance built the right way with insurance companies. In the contract, annuity really just means contract. They say when the market goes up, you get some of it. You participate in some of the gains. When the market goes down, you don't lose a penny. Well, how are they doing that? If you give them $500,000, they're not going to put you in the market. They're not buying mutual funds. They're not buying securities. They're actually putting your money in their bond portfolio, their general fund, and they're taking a little of the interest they earn on your money and buying options on the same market. This is the genius that somebody discovered, 25, 30 years ago, just the genius idea. Don't put your money in the market and be at risk. Buy options on the same market with just a little bit of the interest. And the industry of indexed annuities, indexed universal life insurance, I hear there's indexed CDs. That was born from this. I've been tracking this since the beginning of my career. It beats the market over almost every time frame, if you include the losses, which is important that you do include the losses. You don't just look at 2008 to 2022. If you know how to time the market, you don't need any advice from anybody. Just time the market, get out before the losses and get in before the gains. It's easy if you're clairvoyant. For the rest of us who don't know what the market's going to do, and for all the retirees and families that I help and people like me help, we don't know what's going to happen between now and when you pass away. There's going to be some times where the market goes down. So you have a choice to either lose money when it goes down or keep all the money you've ever made up to that point and wait for the market to go back up. Well, how are they doing that? Again, they don't put your money into the market where you're limited to only 100% of the ups and you still get 100% of the downs. You used to get a portion of the ups and none of the downs. And I'm going to show you some really interesting things about today's market. You notice my chart stops at 2015 because it's not my chart. The company that publishes it stopped publishing it. So I'll show you my research from 2015 on. But I'm really going to kind of call these the market strategy versus the option strategy. And I don't mean risky option strategies where you put your principal into options. And if it goes against you, you lose all your principal. I'm talking about the insurance company version of this, the safe version where they never put any of your principal in. They risk a little bit of your interest every year, or all the interest you could earn for that year, a little bit of the money they make on your money, and they buy call options. The market goes down, you lose it all. So you have all the principal you've ever had, all the interest you earned last year. There's no backwards moves. There's no fees unless you want them. Don't let anybody tell you annuities are terrible because they're talking about single premium immediate annuities or variable annuities. Of course, Some other types of annuities have problems, but it's not fair to take a word that means contract and say things like, I hate contracts and you should too, like Ken Fisher says about annuities. It's not accurate. It's not professional. It's misleading. Indexed annuities have no fees unless you want them. There are no losses. They're beating the market, which I'll show you, but I'm going to talk about this green line strategy, or call it the option strategy. Now, my numbers that I'm using came from MoneyChimp. I love to use this S&P 500 CAGR calculator, compound annual growth rate. It's just a way of accurately looking at what the market has made over certain time frames. So we can see from 1970, this is why everybody loves the market. Make it a little bigger. From 1970 to 1999, before the dot-com crash. Let's include the dividends. The market gave us, if you were in the S&P and didn't have a broker and didn't have fees, you would have made almost 14% compounding for 30 years. Yeah, baby. That's why we love the market. That's why we have all these giant companies. Dean Witter used to be, Edward Jones, Merrill Lynch, Morgan Stanley, everybody. If you don't get the dividends, it's not quite as wonderful, but 10% compounding, we could still say with integrity, more risk equals more reward if you're making 10%. That would have been fair. Why do I talk about the things that I talk about? Why do I have such a passion for teaching on my podcast, the Renovating Retirement podcast, and write the books that I write, and have a meeting every hour of the day on the weekdays, all day long with clients and families? Is because of what's happened in the last 23 years. I'm recording this in 2023, and it's after January 1st. So watch this number down here. If you're not getting the dividends, if you're with a broker or paying fees, the market's only giving you 4.26% compounding for a 23-year period, which includes 2008 to 2022, the longest bull market in history. If you didn't use a broker and you bought the index like Warren Buffett tells his wife to do if he should die, if he passes away, you got a whopping 6.25% for risking your money and for gambling, and for last year having it go down by 18%. So the question is, how much of a percentage of the ups would we need to capture to beat the market if we have none of the losses and some of the gains? How much of the up moves would we need to capture? What percentage, what participation rate is what it's called in the industry? When you partner with an insurance company and you use indexed annuities, indexed universal life insurance, they have different strategies for how you can earn interest. One of them is called a participation rate. It has no ceiling. It has no cap. It has no limit. I like that. That's how I've made my clients their big money over the last 19 years, is make sure we don't have a cap on it, so that the times the market goes way up, 26 right here, 23 right here, 29 right here, 28, 26, and those big up moves, we don't want a ceiling of 6, 7, or 8. You want uncapped, no ceiling, let it rip, baby. So all I've done is take the numbers from MoneyChimp, the annual S&P 500 numbers. Now I'm doing them without dividends, not because I don't understand dividends, because I've reviewed 10,000 families' financials, done 2,000 financial plans, and nobody comes to me with all their money in the S&P 500 index. Almost everybody comes to me with Edward Jones, Merrill Lynch, Morgan Stanley, Ameriprise, some independent broker that's charging a fee, spreading them around into a bunch of things where they're not getting all the dividends of the S&P 500. It wouldn't be fair to pretend that everybody's earning that. I'm using the non-dividend numbers. So maybe you're making a little bit more. That's fine. No, it's the you're going to see a point I'm making here, which is very important. What if we only got half of the up moves? What if in this year, when the market went up, say that was 10%, we only got 5, and went up 20%, we only got 10. But when it went down, we had no losses, no recovery time. This bounce back, let's say it's 20%, we're making 10% on the biggest number we've ever had. This person makes 20% on a little number, we make 10% on a big number. You're trying to earn dollars, remember, not percentages. How many dollars were added to my account this year? You don't need 30% of a tiny number. You might do better with 7% of a big number. Very important. So I asked the software, if we started with $500,000 and I only got 50% of the ups, and during the down years, I don't lose. Here's your market account going down. By the way, some people say, Charlie, you're cherry picking. You're starting with the worst years in history. Of course I'm cherry picking. We're supposed to, as fiduciaries, tell people their risk. So let's take a time in history that didn't go well. By the way, I had a family member where this drop in the market sent her back to work for 13 years. It matters to me. Let's pick a time, that didn't work out and say, at least say to people, honestly, do you know about this? Do you know this could happen again? Is that okay with you? So I'm not cherry picking to beat up the market. I'm cherry picking to say, be aware of this and understand that there's much safer strategies. You don't have to earn very much to beat the market. Market goes down for 3 years. So of course, if you have $500,000 taking all the downs, that red line strategy, we're going down. And if you're in an indexed annuity with qualified funds, or an index universal life insurance policy with after-tax dollars, tax-free growth, the old E.F. Hutton strategy, we hold tight. Now, those of you who are really intelligent say, oh, but isn't there cost of insurance? Ignore that for a moment. Say this is an indexed annuity. There's no fees. You chose no fees. Look at the theory first. We've got no losses. All right. Market goes up. You get a full 26.38% on this small number. How many dollars did you make? It goes up to that. We went up only half of that. We only get half of the 26%. It goes up to here. And it goes like that. All the gains here, half the gains here, all the gains, half the gains, all the gains, half the gains. Boom. All the losses, none of the losses. We hold tight. Okay. So what's our number at the bottom if you're only getting half of the market? Which, by the way, there's products that pay half of the S&P 500 index as a participation rate. You can find them. We end up with $1.6 million in the safe, no loss, green line strategy. The more risk equals more reward, which hasn't been true for 23 years, gave you less of a reward and the roller coaster the entire time. We end up with 24% more money with the safe strategy. We're in a very unique time in history where the safe strategies that don't have fees and can't lose money earn a higher rate of return than the market. That's new. It wasn't like that for our parents and grandparents. This is something new, okay? I'm a numbers person. I like to play with numbers. And so I said, well, how low can we take this? I mean, how amazing is this discovery? Can we make it on 40%? Let's go down. I still have 16% more money in the safe green line, no loss, no fee strategy. Nice. 30%? Whoops, made a mistake. Can I have 30% here? Nice. I still have 8% more money in the safe strategy. Love it. How low can we go? I've already done this on my own. 19%. 19%. If you can get 19% of that, or from the year 2000 until last year, if you could have had a 19% or more participation rate in the S&P 500 index, you would have the same amount of money as someone that took all the ups and all the downs. You just would have never had to pay attention to CNBC. You would have never felt any emotions. Every time the market went down, you'd get a call from your advisor. If you're with me, you'd get a call that said, hey, you're fine. We're just holding tight. We've got all the money you've ever had. Nobody's taking any of it away. The market doesn't get it. When the market rebounds and comes back, you'll make that big percentage on a big account. 19%. So the next question you should be asking yourself is, what are the insurance companies paying? If I could have made it on 19% of the S&P 500, what are they paying? And here's the secret. The S&P 500 is the king tut of indexes. The top 500 most popularly traded stocks. But all it is a measurement of a group of stocks. And what do stocks do? Every group of stocks goes up and down like this red line. There's hundreds, thousands, who knows? Maybe there's millions. I don't know. There's lots and lots and lots of indexes, however you want to say it. And it doesn't matter that much which one you pick. We're looking for volatility, something that goes all over the place. Sometimes it's up, sometimes it's down. When it's down, we don't lose. And when it pops back up, we make a bunch of money. So really what you're looking for is some index that swings around and you can make good money on. Well, here's an example. Are they paying at least 19%? You'll notice the S&P 500 isn't even listed in this particular product. And here's the reason why. The S&P 500 options are really expensive. A lot of the insurance companies have gone to other indices because we just need something that goes up and down. And if options are expensive on the S&P 500 that goes up and down, and they're cheap on something else that goes up and down that measures a different 500 stocks or 55 stocks or 127 stocks, whatever it is, you just need something that goes up and down. Let's see what kind of offers we have. 325% participation. The market goes up 10%, you get 32.5. 250, 240, 355, 100. I love this. 370% participation rate if you'll give them 2 years and let them buy 2-year options. So I'll end the video so it's not a super long training. But what I wanted to talk about today and just have you understand, there's 2 ways to be in the market. There's the traditional way that was modern technology in the 70s, 80s, and 90s, 20, 30, 40 years ago, which was buy positions, buy stocks, use risk, put all your money into buying them, and then hope for the best. Take all the ups and all the downs. You can never make more than 100% of the ups, and you take all the downs and have to recover. Modern technology, the most modern thinking, what's working better than that, because humans are intelligent and we always think about how to improve things. iPhones or telephones, cell phones, computers, cars, they've all gotten better since the 70s, 80s, and 90s. It's no different here. No difference here. The most modern technology is don't put any of your money in the market. Give it to an insurance company or investment company if you can find it, but give it to an insurance company. They have the best contracts that I can find. Let them invest it in their general fund. With the interest they make on your money, they buy stock options for you on the index of your choosing. And as long as you have a good, healthy participation, by the way, 370% is monster high. That's super high. As long as you're getting a good, fair participation rate, 40%, 50%, 100 is good, 370 is better, you should do fine. So if you'd like to talk about this with me, you can get in touch, charlie@renovatingretirement.com, charlie@renovatingretirement.com, or search me online, Charlie Jewett, Jewett. I hope this is helpful for you. God bless you.